All right, welcome back to Iron Financial here on The Explainer. I'm your host, and today we are literally putting on our hard hats, grabbing our clipboards, and heading straight onto the construction site of one of the absolute most talked about tech giants in the entire market. We're performing a full-blown earnings autopsy on Advanced Micro Devices, AMD, and their explosive Q2 2026 financial results. Now, our mission today, and honestly exactly why you should hit that subscribe button right now to join the Iron Financial community, is to help you forge a much stronger portfolio, cut right through the market noise and weakness, and determine whether this massive tech build-out is resting on a rock-solid foundation or if it's kind of just being propped up by shaky scaffolding. To do this properly, I'm going to be channeling two distinct perspectives for us today. First up, we've got our lead analyst persona, intense, deeply analytical, and razor-focused on hard metrics and institutional-grade revenue growth. And second, we have our market skeptic, representing the cautious retail investor, stepping into the room and asking the tough questions like, hey, is this AI growth truly sustainable, or is it pure hype masking some serious structural cracks? Okay, let's roll out the blueprints and see what AMD is actually building here. Right out of the gate, our lead analyst kicks down the door with the absolute most critical metric of the entire quarter, $11.5 billion. That is AMD's record total revenue for the second quarter of 2026. In the incredibly complex world of semiconductor architecture, this number represents the ultimate foundational blueprint. Look, when you are evaluating a company that is attempting to power the absolute next generation of artificial intelligence, a top-line print of $11.5 billion in a single 90-day period, that proves they aren't just sketching out vague concepts on a whiteboard, they are actively pouring the concrete. This represents a staggering scale of operation that, frankly, only a handful of companies on Earth can physically manage. And it's being driven by this incredibly broad-based demand for their high-performance AI portfolio. But, a massive static number only tells us the ultimate size of the building, right? It doesn't tell us the speed at which it's actually going up. And the sheer velocity of this growth is what really matters. That $11.5 billion represents a massive 50% increase year over year, compared to the $7.68 billion base they poured back in Q2 of 2025. And sequentially, they are up 13% quarter over quarter from Q1 2026's $10.25 billion. Our lead analyst points straight to this momentum and says, look, this is undeniably bullish execution. To really understand why this is so impressive, you have to remember that the hardware and semiconductor industry is notoriously cyclical. It's totally subject to these massive boom and bust periods. Stacking a 13% sequential gain directly on top of a 50% annual gain, all while operating at an $11 billion scale, that requires incredibly difficult heavy lifting. It proves they are absolutely taking market share in real time. But before the market skeptic can even get a word in about historical tech bubbles, our lead analyst directs our attention to exactly which division is swinging the biggest hammer on the site. Section 1. Load bearing. The data center surge. Think about it like this. Every skyscraper has a central, load-bearing pillar that keeps the entire structure from just collapsing under its own immense weight. For AMD in 2026, we are transitioning into the absolute powerhouse of their business. I'm talking about the data center. Here is where the real heavy lifting happens. The data center segment didn't just grow, it completely exploded, delivering a staggering $6.7 billion in revenue for the quarter. That is an astonishing 107% year-over-year growth compared to the $3.2 billion they reported in Q2 of 2025. This doubling of revenue is being driven by two massive engines running in tandem, the EPYC server CPUs and the Instinct GPUs. Let's actually drill into the hardware for a second here. The adoption of their fifth-generation EPYC processors has rapidly expanded across both cloud providers and enterprise customers who are just desperate for compute efficiency. Meanwhile, the Instinct GPUs, specifically the new MI350 series, are scaling so aggressively, delivering an incredible 35x improvement in inference performance. Our lead analyst absolutely marvels at the structural integrity, noting that 8 of the world's top 10 AI companies are right now running production workloads on AMD's Instinct. Now, to truly understand AMD's transformation, we have to recognize that the load has completely shifted. The data center segment now represents a massive 58% of the company's total revenue. Let that sink in for a minute. AMD is no longer a traditional PC or gaming company that just happens to make servers on the side. It has completely re-engineered its financial framework. It is an AI and data center company, first and foremost. When a single division represents nearly 60% of an $11.5 billion quarter and is growing at 107% year over year, it becomes the absolute bedrock of the stock's valuation. Section 2. Structural cracks, gaming softness. But hey, this is Iron Financial, and we don't just stand around admiring the shiny new exterior. We inspect the whole building. It's time for the market skeptic to step onto the site, throw on a hard hat, and start poking holes in the drywall. Because while the data center is holding up the roof, other parts of the foundation are showing some serious structural cracks. Our skeptic immediately points to a really aggressive divergence in the consumer-facing segments, which totaled $3.8 billion combined. On one hand, you have the client segment, driven by those Ryzen CPUs, which posted a very solid $3.1 billion, up 23% year over year. That's good, sturdy framing. But then you look at gaming. The gaming segment collapsed to just $779 million. That is a severe 31% year-over-year decline. The skeptic steps right in, aggressively asking, why is a third of the gaming business just evaporating? Well, the reality is the semi-custom market, the chips powering the aging PlayStation 5 and Xbox console cycles, is drying up rapidly as consumer demand falls off a cliff. But when an entire wing of your building is shrinking by a third, you really have to ask, is this creating a precarious overhang? Can the explosive high-margin growth in the data center indefinitely mask and subsidize this severe decay in gaming? If you are buying AMD at today's valuation, you're definitely paying a massive premium for the AI growth, but you are also inheriting a legacy gaming business that is currently in freefall.
Section 3. Inspecting the scaffolding. Margins.
So we have hypergrowth on one side and heavy contraction on the other. It's time for both our analyst and our skeptic to sit down at the drafting table, tear down the income statement, and transition into a strict, clinical spreadsheet analysis of the company's margins and profitability. Let's literally drill into every single reconciliation point, bridging GAAP to non-GAAP, because this is exactly where the hidden costs of construction live. On a strict GAAP basis, gross margin sits at 54%, which, to be fair, is up 14 points from last year's 40%. That is an objectively fantastic improvement. But on a non-GAAP basis, management reports it at 56%. So why the 2% gap? Well, the market skeptic points directly to approximately $440 million of net inventory and related charges associated with U.S. government export controls on AMD's Instinct MI308 data center GPUs. That is a massive regulatory crack in the plaster that directly hit the gross profit line. Now let's look at the bottom line. GAAP net income is $2.3 billion, or $1.38 per share. But management's preferred non-GAAP net income paints a much rosier picture at $2.8 billion or $1.66 per share. Our lead analyst defends the core operating leverage here, eagerly pointing out that operating income exploded 1,585% year over year to hit $1.99 billion. But the skeptic steps right back in to ensure we keep our balance here. Hold on. Management wants us to look at the non-GAAP numbers, but to get there, they add back $503 million in stock-based compensation and another $544 million in amortization of acquisition-related intangibles. For the everyday retail investor, stock-based compensation might seem like monopoly money because it doesn't technically reduce cash in the bank today. But it is a very real economic expense because it issues new shares, directly diluting the value of the shares you already own. That's over $1 billion of real economic value being magically adjusted away on the spreadsheet. So the scaffolding is holding, sure, but it's incredibly expensive to maintain.
Stepping away from the income statement for a second, the lead analyst points to the balance sheet to defend AMD's ultimate structural integrity. You know, you can debate non-GAAP adjustments all day long, but cash in the bank doesn't lie. AMD generated a massive $1.56 billion in free cash flow this quarter. They're sitting on a record-breaking pile of $13.11 billion in cash, cash equivalents, and short-term investments, which is actually up 6% just from last quarter. Against that mountain of liquidity, they carry only $3.23 billion in total debt, which remained totally flat quarter over quarter. What's really interesting about this setup is exactly how it fuels the future. The lead analyst argues that this free cash flow generation is the true poured concrete of the foundation because it easily covers their incredibly intense research and development spend. Look, to keep pace with competitors like NVIDIA in this insane AI arms race, AMD literally has to burn billions in R&D. Generating over $1.5 billion in free cash flow after those R&D expenses proves they have a genuine financial fortress. They can fund aggressive development, navigate those annoying inventory write-downs we talked about, and continue acquiring whatever technology they need to win the AI infrastructure war, all without over-leveraging the company.
Section 4. The Forward Blueprint. Guidance and Scaling.
The foundation is set, and the Q2 results are etched in stone. But as we all know, the stock market doesn't pay for the building you already built. It pays exclusively for the blueprints of the one you are about to build. Management has laid out their guidance, and it is aggressive. For Q3 2026, they are projecting a revenue midpoint of $13.0 billion, plus or minus $300 million. If they hit that midpoint, we are looking at roughly 41% year-over-year growth. The lead analyst absolutely loves this trajectory, specifically noting that the CFO stated data center sales are going to accelerate even further in the second half of 2026. However, they expect the non-GAAP gross margin to hold essentially flat at approximately 56%. And here, the market skeptic chimes in with a really critical question. Wait a second. If the highly profitable data center is accelerating and becoming an even larger piece of the pie, shouldn't overall gross margins be expanding beyond 56%? The reality of scaling AI accelerators involves brutal supply chain constraints, advanced packaging limits, and massive, intensive hardware costs. The skeptic warns that 56% might be the absolute ceiling for this structural build-out, meaning every additional dollar of revenue might actually get more expensive to produce. To actually hit that $13 billion number, AMD is relying on physical bedrock, the copper-plated, liquid-cooled reality of the AI infrastructure build-out. The lead analyst explains that the game has fundamentally changed. It's no longer just about selling individual chips to server makers. It's about designing and selling massive rack-scale solutions. AMD is ramping up their Helios rack-scale architecture and scaling the Instinct GPUs at an unprecedented rate. Furthermore, their recent acquisition of ZT Systems is directly aimed at accelerating this specific capability. ZT Systems basically gives AMD the heavy industrial engineering expertise required to deploy AI at the hyperscale level faster and significantly more efficiently. They are moving so rapidly from selling individual parts to providing the entire integrated compute foundation for the world's largest data centers. And who exactly is buying these massive rack-scale solutions? Well, the scale of these strategic partnerships brilliantly illustrates the ultimate validation of AMD's blueprint. We aren't talking in terms of millions of dollars anymore. We are literally talking in gigawatts of power consumption. Anthropic is deploying up to 2 gigawatts of Instinct GPUs for their large language models. Meta has signed an agreement to deploy up to 6 gigawatts of AMD GPUs, starting with custom MI450s and 6th-gen EPYC CPUs. To put that staggering number into perspective for you, 6 gigawatts is enough electricity to power a medium-sized country. And as part of that highly strategic deal, Meta actually received warrants to purchase up to 160 million shares of AMD, which ties Meta's financial success directly to AMD's execution. Add in the aggressively expanding cloud footprint with Microsoft Azure, and our lead analyst argues that these multi-gigawatt partnerships are the unbreakable iron beams locking AMD's long-term growth firmly in place. Section 5. The final verdict. Rock or rubble? Okay, so we've inspected the $11.5 billion in record revenue, we've tapped out hammers on that massive 107% data center growth, we've noted the severe 31% decay in gaming, and we forensically audited the GAAP to non-GAAP reconciliations. So is AMD a solid buy opportunity right now, or is it a high valuation trap? Here's the iron financial wrap-up. Our market skeptic wants you to remember that the drop in gaming is real deadweight. That $440 million inventory charge for the MI308 proves that geopolitical export risks are very much alive and well. And adjusting away $1 billion in stock-based comp and amortization means you're definitely paying a massive premium for a highly complex build. But our lead analyst counters all of that with the sheer financial force of the company. When you have an ironclad balance sheet of $13.11 billion in cash, over $1.5 billion in free cash flow, fully funding your R&D, and unprecedented multi-gigawatt deployments locked in with the likes of Meta and Anthropic, the load-bearing pillar of the data center appears more than strong enough to carry this entire company. The foundation looks rock solid for now. But in the high-stakes, intensely competitive game of AI infrastructure, we know the tectonic plates are always shifting. So we leave it to you, the focused learner. Are you buying the blueprint right now? Or are you waiting for the dust to settle on those legacy gaming segments? Let us know in the comments below, keep inspecting those portfolios, and we will absolutely see you on the next deep dive right here on The Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.